Hi everyone, today we'll be going over accounts, May June 2022, paper 1-3. This is a multiple choice paper which consists of 30 questions, each of 1 mark, and we are also given a time limit of 1 hour. So without any further delay, let's get started. For the first question, we're given the information that Mia has agreed to supply goods to a customer on a sale or return basis. At the end of her financial year, the customer has not indicated whether they will keep the goods. Which accounting concept should Mia apply to these items in her financial accounts? Okay, so we are considering a sale or return basis where the customer has not yet indicated whether they will keep the goods, and we need to figure out which accounting concept should Mia apply. The first option given is the matching one, and we know that matching concept states that we need to match our costs to the revenues. And in this case, we are selling goods on a sale or return basis, which means that the revenue has yet not been generated because the customer has not indicated whether they will keep the goods. So matching concept would not be the correct accounting concept in this case. So option A is incorrect. And the second option given is the prudence concept. And we know that prudence concept states that profit should not be overstated. Again, in this case, we are supplying goods on a sale or return basis, which means that the revenue has not yet been generated, due to which the profit has not been generated yet as well. And due to that reason, we cannot be overstating the profits in this case. So prudence concept is also incorrect. The third one is realization, and the realization concept states that revenue should only be recognized when the underlying goods or services have been rendered. And in this case, we are selling the goods on a sale or return basis. So the customer has not yet decided whether they are going to keep the goods or they will send it back to us, due to which the revenue has not yet been generated. And so we will be applying realization concept, as it states that revenue should only be recognized when the underlying goods or services have been rendered. In this case, it has not been rendered yet. So we do not recognize this as sales under the realization concept. So our correct option is going to be option C. But let's have a look at option D as well. The fourth one is substance over form, and this concept ensures that the financial statements give a complete, relevant, and accurate picture of transactions and events, which in this case is not really relevant to the information given in the question, right? So option D is going to be incorrect as well, and our correct answer for question number 1 is going to be option C. Okay, now we can move towards question number 2. We need to figure out which item should be treated as a capital expenditure. Okay, capital expenditure are those items which will be non-recurring, which means that it only occurs once and it does not occur in a repeated manner in the future as well. And we will be looking for that item among these 4 options. The first one is cost of a printer for an existing computer system. Okay, so this is definitely a purchase of the printer. And once we purchase the printer, we do not have to purchase it very often because already we have a printer, right? So maybe we might need to buy inks, which would be our revenue expenditures, but printer we only buy it once, which would categorize it as a non-recurring expense, due to which we can treat this as a capital expenditure, which means that option A will be our correct answer. But let's have a look at the remaining options as well. The second one is rent paid on a factory whilst the company negotiated the purchase of the factory. So rent paid is obviously an expense which occurs every month, right? And these are the expenses that are recorded in our income statement, which was obviously categorize it as our revenue expenditure. So option B is incorrect. The third option is repainting the wooden office door. So remember that this is repainting, which means that the wooden office door had been painted before, but it required painting again, which could mean that it would require painting in the future as well. So this is a recurring expense, due to which we should be treating this as our revenue expenditure rather than capital expenditure. So option C is incorrect. And the fourth one is repair costs to a car which are not covered by insurance. Again, repair is something that has to be done time and again, so we can categorize it as a recurring expense, due to which it should be treated as revenue expenditure. So option D is incorrect as well. So the correct answer for question number 2 is going to be option A. Now we can move towards question number 3. A business has a financial year end of 31st December. It purchased a vehicle on 1st January 2019 for 30,000. So this is the cost of the vehicle, right? And the business depreciates vehicle at the rate of 20% per annum using the reducing balance method. And under reducing balance method, whenever we are trying to figure out the depreciation, we would be multiplying our rate to the net book value rather than the cost. And net book value is just the difference between the cost and the accumulated depreciation. And we're also told that the depreciation is charged on a month-by-month basis. So for each month that we have been using this vehicle, we should be charging the depreciation. And we're told that vehicle was sold on 30 September 2021. Okay, so I'm just going to create a timeline. Okay, this is the year 2019, and we know that we purchased the vehicle on 1st January 2019, so this is the beginning date, and we have been using the vehicle for the entire months of 2019, right? So for all 12 months, we should be charging depreciation for the year 2019. Then we have 2020. But we are told that the vehicle was sold on 30 September 2021, which means that for the entirety of 2020, we use the vehicle as well. So we should be charging the depreciation for 12 months as well. And for the year 2021, we are told that the vehicle was sold on September 2021, and it's 30 September. So we have been using the vehicle for the entire month of September as well. So the remaining months will be October, November, and December. So for the 3 months, we will not be using the vehicle, but for the remaining 9 months, we had been using the vehicle, right? So we should be charging the depreciation for 9 months for the year 2021. Now, a profit on disposal of 3,000 had been calculated. However, no entries had been made to record the depreciation of 2021. Okay, so while figuring out the profit on disposal of 3,000, we had not considered the depreciation charge for the year 2021, which means that we had only been charging the depreciation for the year 2019 and 2020 in this case. Now, we need to figure out what was the effect of not recording the depreciation for 2021 on the profit on disposal. In this case, we now need to figure out the additional depreciation charge on the year 2021 and then figure out the corresponding profit on disposal for this case, right? But in order to figure out the profit on disposal, we would require our disposal value, which is not given, but we have our profit on disposal, which was figured out after applying the depreciation for the year 2019 and 2020, right? So in that way, we could figure out our net book value and then compare it with the profit on disposal in order to figure out the disposed value. Let's figure out the depreciation charges. So for 2019, we know that we are applying depreciation using the reducing balance method, which means that we need to charge our rate of depreciation to the net book value. But in this case, 2019 is the year of purchase, which should make our cost equal to the net book value. So we can apply the rate of depreciation to the cost itself, and the cost given is 30,000. So the depreciation for 2019 is just going to be 30,000 times the rate, which is 20%, which we can write down as 0.20. And this gives the depreciation charge for the year 2019 to be 6,000. Now let's figure out the depreciation charge for the year 2020. But remember that for 2020, we already have our accumulated depreciation, which will be the depreciation charge for 2019. So we need to figure out the net book value. That would be cost minus accumulated depreciation, which in this case is 30,000. That's the cost, minus the accumulated depreciation, which is the depreciation for previous years. And in this case, we only have 1 year, which is 2019. So we need to subtract 6,000 depreciation in order to figure out the net book value. Now we can multiply it with the rate of 20%. And this gives our depreciation charge for 2020 to have the value of 4,800. And remember that only the depreciation for these 2 years were charged in order to figure out the profit on disposal of 30,000, right? So we should be figuring out our net book value corresponding to these accumulated depreciation. So the net book value is just the difference between cost and accumulated depreciation, which in this case will be the depreciation for the year 2019 and 2020. So net book value is 30,000 minus the depreciation for 2019, which is 6,000, minus the depreciation for 2020, which is 4,800. And this gives the value of 19,200. Okay, and we know there is a profit on disposal. So profit only occurs when the disposed value is greater than our net book value, right? So the profit is calculated by subtracting the net book value from the disposed value. And in this case, we are given the profit of 3,000. We need to figure out the disposed value, and we have our net book value to be 19,200. Now we can easily figure out the disposed value. That is just going to be 3,000 plus 19,200, which results in the disposed value to be 22,200. Okay, now we need to figure out the actual profit on disposal after considering the depreciation for the year 2021 as well. So let's figure out the depreciation charge for 2021. We should be subtracting the depreciation charges for the previous year, as they would be the accumulated depreciation, right? So the net book value is going to be 30,000 minus 6,000 minus 4,800. And now we can multiply it with the rate of depreciation, which is 20%. But remember that this would give the depreciation for an entire year, which is 12 months. But we are only using the vehicle for 9 months in the year 2021. So we only require the depreciation charge for 9 months out of the 12 months. So we will be multiplying it with 9 and divide it by 12. And this gives the depreciation charge for the year 2021 to be 2,880. Okay, so now we need to figure out the corresponding net book value. That would be 30,000 minus the depreciation charges for the year 2019, 20, and 21. So that's 6,000 minus 4,800 minus 2,880. And this gives the actual correct net book value to have the value of 16,320. Okay, and we already have the disposed value, which means that in order to figure out the profit on disposal, we just need to subtract the net book value from the disposed value. So that's 22,200 minus the actual net book value of 16,320. And this gives our profit to be 5,880. Okay, and we need to figure out the effect of not recording the depreciation on the profit on disposal. So we need to compare the two different profit on disposals. Previously it was 3,000. Now the actual correct amount should be 5,880. We can definitely see that the profit on disposal has increased. So previously it had been understated, right? And in order to figure out the understatement amount, we just need to find the difference between those two profit on disposals. So that's 5,880 new profit on disposal that we figured out minus 3,000 previous profit on disposal, which gives the understatement amount to have the value of 2,880. So our correct answer is going to be 2,880 understated, which is given in option C. That would be our correct answer. Now we can move towards question number 4. A trader bought a machine on 1st January 2019 and he depreciated it at a rate of 10% per annum using the straight line method, which means that the depreciation charge or rate of 10% is being applied to the cost for all years. And he sold his machine on 1st January 2021 for 4,000. So this is the sale proceeds value, and the profit on disposal was 200. Now we need to figure out how much the machine cost on 1st January 2019. So let's indicate our cost with the variable C. And in order to gain a profit on disposal, we need to figure out our net book value to compare it with the sale proceeds, right? So our first step would be to figuring out the net book value. And net book value is just the difference between the cost and accumulated depreciation. So we have indicated our cost with the variable C. Now we need to figure out our depreciation charge in terms of C as well. So depreciation charges. And remember that the machine was bought on 1st January 2019 and sold on 1st January 2020, which means that this machine was used for the entirety of 2019 and the entirety of 2020. So our accumulated depreciation is going to be the depreciation charge for 2 years, right? So I'm just going to figure out the depreciation charge for 2 years. We have our cost C, and the depreciation rate is 10%. And since we are using straight line method, we should be applying this rate to the cost for all years, right? So I'm just going to multiply 0.10, and this would give the depreciation charge for 1 year, but we are requiring it for 2 years, right? So I'm just going to multiply it by 2, and this gives our accumulated depreciation to be 0.20 times C. Now we can easily figure out the net book value. It is just the difference between cost and our accumulated depreciation, which we just figured out to be 0.20 times C. If we take C common, that would be 1 minus 0.20, and that gives our net book value to be 0.80 times C. Now we already have the profit on disposal as well as the sale proceeds, and profit occurs when the sale proceeds is greater than the net book value. So the formula for profit is going to be sales minus net book value, right? Now let's substitute the values. The profit on disposal is 200. The sale proceeds is 4,000. And we just need to subtract the net book value, which is 0.80 times cost. Now we can easily figure out the value for C. That is going to be 0.80 times C equals to 4,000 minus 200. And this gives our cost to be 4,000 minus 200 is 3,800 divided by, this goes to the other side as a denominator, 0.80. So this gives our cost to have the value of 4,750. And this amount is given in option B. That is the correct answer. Now we can move towards question number 5. We need to figure out which item is recorded on the credit side of a sales ledger control account. Okay, the very first one is discount received. Discount received is not included in our sales ledger control account at all, because remember that discount received is something that we receive while purchasing, and we are talking about sales ledger control account, right? So option A is incorrect. The second one is dishonored check. Dishonored checks are always included in the debit side in our sales ledger control account. So this is incorrect as well. The third option is interest on overdue accounts. Again, this is also included in the debit side of a sales ledger control account. So option C is incorrect as well. And the fourth one is set off of amounts in the purchase ledger. This is basically contra. And we know that contras are recorded on the credit side of a sales ledger control account. So option D is going to be our correct answer. Now we can move towards question number 6. The bank column of a cash book showed the credit balance of 2,915. This did not agree with the bank balance shown on the bank statement. Alright, and we are given some discoveries of errors. When these items were adjusted, the cash book balance agreed with the bank statement balance. What was the balance shown on the bank statement before any adjustments were made? Alright, so we need to prepare the bank column of a cash book as well as the bank statement itself. Now, I will be starting with the bank column of the cash book, and I will be preparing it in the form of T account. So this is the debit side, this is the credit side. And remember that in the bank column of the cash book, the debit side includes all of the incomes or inflows, whereas the credit side includes all of the outflows. And I'll also prepare the bank statement here. So this is the debit side, this is the credit side, and this is the total amounts. But in case of the bank statement balance, debit side is going to include all of the outflows, whereas the credit side is going to include all of the inflows. So a credit balance of 2,915 shown on the bank column of the cash book is going to indicate the debit balance in our bank statement balance. Okay, I'll only be focusing on the bank column and then move to the bank statement balance. So we need to start with our draft balance, which is the credit side, with the amount of 2,915, right? So this is our balance for the credit side. Now we need to figure out which of these errors should be adjusted in our cash book. So the very first one is a bank transfer, 150 from a customer. So this is from a customer, so we are receiving it. So this is an inflow, right? Was not recorded in the cash book, which means that we need to record it now in our cash book. This is an in, which would obviously be recorded on the debit side, and the amount is 150. So we're just going to record 150 on our debit side. Now the second one is a check for 150 received from a customer. Again, this is something that we are receiving. So this is an inflow as well. Was not recorded on the bank statement. So this is not recorded on the bank statement, but it does not indicate anything about the bank column of the cash book. So we are just going to assume that this has already been recorded in the cash book. And since we are only focusing on the cash book firstly, I'm just going to ignore this error 2 for the time being. Now we move to the third one, a check 530 issued to a supplier. So we are actually providing it to our supplier, which means that this will be an outflow, right? Was incorrectly recorded in the cash book. So we need to rectify this error in our cash book, and was correctly recorded by the bank. So this does not need to be corrected in our bank statement. This only needs to be corrected in our cash book. Okay, so it was incorrectly recorded as 350, but it should actually have been 530. So firstly, I'm just going to eliminate this incorrect amount of 350. We've already figured out that this is an outflow, which was obviously recorded on the credit side. But instead of recording 530, we had previously recorded 350 on the credit side. So in order to eliminate that 350 on the credit side, we could just put the same amount on our debit side. So that way, those two amounts cancel each other out, right? So I'm just going to put 350 on the debit side in order to eliminate the wrong amount. And now I will be writing down the correct amount on the outside, which is the credit side, right? And the correct amount is 530. So I'm just going to write down 530 on the credit side, indicating that this is the correct amount that we issued to a supplier. Okay, now we can move towards the fourth one. Bank charge 25 was not recorded in the cash book. So we need to adjust this in our cash book. And bank charge is something that we need to pay to the bank, right? So this is an outflow as well, which means that this 25 should be recorded on the credit side. So that's going to be 25. These are all the adjustments to be made in our cash book. So I'm just going to figure out the new balance, right? Obviously the credit side is heavier. Let's figure out the total for credit side. That's 2,915 plus 530 plus 25, which results in 3,470. And the total is to be same for the debit side as well. Now the new balance or the closing balance is just going to be our balancing figure. And in order to figure out the balancing figure, we just need to subtract these amounts from the total. So that's 3,470 minus 150 minus 350, which results in the closing balance to have the amount of 2,970. So that to the other side would be balance BD with the amount of 2,970. So again, after correcting all of these errors, we have figured out a credit balance of 2,970. Okay, like I said before, this is an out, right? The credit means out. And in our bank statement balance, the out is actually recorded on the debit side, which means that the correct balance for the bank statement is 2,970 on the debit side, right? That's 2,970. And the total is just 2,970 debit side. But we are asked to figure out the balance shown on the bank statement before any adjustments were made. So we just have to go through these errors to figure out the one which should be adjusted in the bank statement. So the first one was not recorded in the cash book. This does not indicate anything about our bank statement. So we just assume that it was recorded correctly in our bank statement. So we ignore this. The second one is a check 450 received from a customer was not recorded on the bank statement. So this should definitely be rectified in our bank statement, right? So this is an in, which should be recorded on the credit side in case of our bank statement. So that's just going to be 450 on the credit side. The next one was correctly recorded by the bank, so this does not need to be corrected in our bank statement. And the final one is bank charge. So bank charges are automatically recorded in the bank statement, so this does not need to be rectified as well. So the only error to be rectified is the 450 on the credit side. And now we require the balance before this error was rectified. And we know that our total is 2,970, right? So if our debit amount is A, I'm just supposing this as a variable. In this case, our total would be A debit, right? But after considering a credit amount of 450, our total would be A minus 450 debit. Because remember that debit and credit are just the opposites. So I'm just going to subtract the credit sides from the debit sides, assuming that this debit value is higher than the credit value. And now this value is equal to 2,970. So that's A minus 450 equals to 2,970. So in this case, our variable A has a value of 2,970 plus 450, which results in 3,420. So the actual balance shown on the bank statement before any adjustments was 3,420 on the debit side. This is the answer that we are looking for. And 3,420 debit is given on option C. That would be our correct answer. Now we can move towards the seventh question. The correction of which error would require an entry in the suspense account? So the very first one is a sales invoice 45 was omitted from the sales journal. And remember that trial balance does not show the error of omission. And in this case, the sales invoice is being omitted. So the rectification of this error would not require an entry in the suspense account. This is an incorrect option. And the second option is drawings 60 were debited in the cash book and were credited to the drawings account. So this has been recorded on the opposite sides. And this error was not really shown by the trial balance, so this is incorrect as well. The third one is vehicle repairs 100 were debited to the vehicles at cost account. So remember that vehicle repairs is also an expense and vehicles at cost is also an expense. So in this case, we have been treating this 100 correctly but under the wrong account, right? So this is error of commission, which is again not shown in the trial balance. Option C is incorrect. And the fourth one is wages 150 were correctly recorded in the wages account and debited in the cash book. So it should have been actually credited because this is an expense, right? And this is the error that in order to rectify, we need to create an entry in the suspense account. So option D will be our correct answer. Now we can move towards question number 8. The amount of expense for rent and rates recorded in the income statement for the year ended 31st December 2021 was 76,230. Then we are given the information regarding rent accrued and rates prepaid for the opening date as well as the closing date. Now we need to figure out how much was paid from the bank account for rent and rates during the year ended 31st December 2021. Okay, so the very simple thing to remember here is that whatever amount was paid from the bank account, let's suppose a variable B for that, right? And all of these rents accrued and rates prepaid is to be adjusted to the actual amount paid from the bank account in order to figure out the amount to be recorded in the income statement, right? So this just means that to the B, we will be adjusting all of these amounts, and that would be equal to the income statement amount, which is 76,230. All right, so let's adjust these amounts first. We have rent accrued, and this is the balance brought forward for 1st January 2021, which means that this is the rent accrued for the year 2020. And accruals is something that is the expense for that year which has not been paid yet. So this 4,000 is actually the expense for the year 2020, and we are talking about the income statement for the year ended 2021. So this expense of the previous year should not be included in the current year. So we're just going to subtract the 4,000. Then we have rent accrued for 31st December 2021, which is the year 2021. So this amount of 6,500 means that this is the rent for the year 2021, which has not yet been paid for. But this should obviously be recorded in the income statement, right? So I'm just going to add the amount of 6,500. Then we have the rates prepaid, and this is for the year 2020. So 770 was prepaid in the year 2020, which means that this is actually to be used as an expense for the next year, which is 2021. And since we are talking about figuring out the amount to be recorded in the income statement for the year 2021, this amount of 770 should definitely be included. So I'm just going to add the 770. And then we have rates prepaid for 2021. So this is the amount prepaid in the year 2021, which should be the expense for the next year, which is 2022. And the future year's expense is not to be recorded in the current year's income statement. So we do not have to include this 820. I'm just going to subtract this. And this will equal to the amount recorded in the income statement, which is given to be 76,230. Now we can easily figure out the paid amount from the bank account. That's just going to be 76,230 plus 4,000 minus 6,500 minus 770 plus 820, which results in the amount of 73,780. This is the answer that we're looking for, and this is given in option B. That is the correct option. Now we can move towards question number 9. Which statements regarding the financial statements of a sole trader are correct? So the first one is cash drawings for the year are recorded in the income statement. This is incorrect because remember that drawings are recorded in the capital section in our statement of financial position, not income statement. And the second one is gross profit for the year is shown in the statement of financial position. Again, this is incorrect because gross profit is shown in our income statement. The third one is prepayments only appear in the income statement. Like we did before, we excluded all of the prepayments from our income statement, right? So obviously this statement is incorrect. And the fourth one is trade receivables appear in the statement of financial position. This is correct because trade receivables is our current assets, which will be recorded under this heading in our statement of financial position. So the only correct statement from these four are fourth one, which is given in option D. That will be the correct answer. Now we can move towards question number 10. A business provided the following information regarding its first year of trading. We have our credit sales, receipts from credit customers, irrecoverable debt written off, contra recorded between purchase ledger and sales ledger, and the net trade receivables recorded in the statement of financial position at the end of the year were 16,660. We need to figure out the balance on the provision for doubtful debts account at the end of the year. Okay, so all of the sales given is the credit sales. Alright, so I'm just going to prepare an equation here. So we're starting with credit sales. And the second one we have is our receipts from credit customers. So the receipts from credit customers would obviously reduce our trade receivables, right? But this credit sales gives rise to the trade receivables. So since this will reduce our amount of trade receivables, we need to subtract this, right? So that's receipts. The third one is irrecoverable debt written off. So irrecoverable debt written off would obviously reduce our trade receivables as well, right? So we need to subtract that. And the fourth one is our contra between purchases ledger and sales ledger. So contra is basically a set off between the purchases and sales. Those set off would obviously reduce the amount to be received as well as the amounts to be paid, which means that trade receivables value will also be decreased by this amount. So we need to subtract our contra as well. And we need to figure out the provision for doubtful debts. And remember that provision for doubtful debts is again subtracted in order to figure out the net receivables. Right, so we need to subtract our provisions as well, and this would give our trade receivables. Now we can just substitute the values. So our credit sales, as we can see here, is 93,730. We need to subtract the receipts, which is 76,500. Then we need to subtract our irrecoverable debts of 150, as well as our contra of 80. And we need to figure out the provision. And we're also given the trade receivables at the year end, which is 16,660. Now we can easily figure out the provision. That is 93,730 minus 76,500 minus 150 minus 80 minus 16,660, which results in the value of 340. So this is the provision for doubtful debts account at the end of the year, which is given in option A. That is the correct answer. Now we can move towards question number 11. We need to figure out which items are recorded in the income statement of a sole trader. So the very first one is interest payable on bank loan. So interests are definitely recorded on our income statement for a sole trader, right? This is the correct one. The second one is interest on capital. And we are talking about sole trader, and interest on capital is only recorded for partnership business, but it is also not recorded in the income statement. It is recorded on our appropriation account. So second statement is incorrect. So the second item is incorrect. And the third one is transfer to general reserve. So transfer to general reserve is actually recorded in our statement of changes in equity rather than the income statement. So item 3 is incorrect as well. Only correct item is item 1, which is given in option C. That will be the correct answer. Now we can move towards question number 12. A summary of traders' bank statements for his first year of trading showed the following amounts. We have our receipts from credit customers as well as the cash sales takings banked. And we are told that the trader took 2,000 every month from takings as drawings before banking the remaining takings. And the trade receivables at the year end amounted to 9,500. We need to figure out the total revenue for the year. Okay, so the very first one is receipts from credit customers. So if we are talking about credit customers, those arises from credit sales, right? And since we are trying to figure out the total revenue, we should be considering credit sales as well. So we will be adding this amount of 25,000. Then the second one is cash sales. So obviously we should be recording this amount as well. That's 82,000. And remember that the trader has been taking 2,000 every month from takings as drawings before banking, right? So this amount does not include those drawings which were taken from the sales value, right? So we should be recording those drawings amount as well, as it was sales essentially. So plus 2,000. And remember that this 2,000 was every month. So for the 12 months, that's going to be 2,000 times 12. And the last information we have is trade receivables, and trade receivables is the amount that arises from credit sales. Again, those should be recorded in order to figure out the total revenue, right? So we just need to add the trade receivables of 9,500, and this will give our total revenue. So that's 25,000 plus 82,000 plus 2,000 times 12 plus 9,500, which results in the value of 140,500. This is the total revenue, which is given in option D. That will be our correct answer. Now we can move towards question number 13. Jane provided the following information about her business. We are given the total assets as well as current liabilities for the opening date and the closing date. Then during the year, the business took a long-term loan. Long-term loan is non-current liabilities. And Jane's drawings total 12,000. We need to figure out Jane's profit for the year ended 31st December 2021. Okay, let's review our equation. So that's total assets is equal to the current liabilities plus non-current liabilities plus the capital, right? And for the opening date, we have our total assets, we have current liabilities, but we are given no non-current liabilities. So we're just going to assume that the non-current liabilities is 0 in this case. So let's figure out the capital. That's the total assets of 108,000. We have our current liabilities of 7,500. We are going to assume non-current liabilities to be 0, and we are trying to figure out our capital at the opening date. So the capital is just going to be 108,000 minus 7,500, which results in the value of 100,500. So this is the opening date capital balance. Now we repeat the same process for the closing dates. We have our total assets to be 119,000 equals to the current liabilities of 11,500. And remember that during the year, we took out a long-term loan, which is a non-current liability. So now the non-current liability has a value of 10,000. So that's plus 10,000 plus the capital balance. So the capital balance for the closing date is 119,000 minus 11,500 minus 10,000, which results in the value of 97,500. Okay. Now I'm going to prepare this statement for our capital account. So we definitely start with the opening balance, right? And in our opening balance, we add all of the profits. We subtract all of our drawings, which will give the closing balance. And we have our opening balance to be 100,500. This is for the date of 1st January 2021. We have our closing balance to be 97,500. This is for the date of 31st December 2021. Then we have our drawings for the year to be 12,000. So we're just going to subtract those 12,000. And now we need to figure out the profit. So profit now acts as a balancing figure. And in order to figure out the balancing figure, we need to subtract these values from the total. In this case, that's going to be 97,500 minus 100,500 plus 12,000, because two negatives make up a positive. In this way, the profit amount is going to be 9,000. Alright, and this 9,000 is given in option B. That will be our correct answer. Now we can move towards question number 14. We need to figure out which factors may cause a partnership to revalue its tangible non-current assets. So revaluation is only done when there is admission of new partner or the retirement of a partner, right? So we're just looking for those two factors. And the first one is admission of a new partner. This is the correct one. Second one is change in the profit sharing ratios. This is the incorrect one. And the third one is retirement of a partner, which is again a correct one. So the correct factors are 1 and 3, which is given in our option B. That will be the correct answer. Now we can move towards question number 15. L and M were in partnership, sharing profits and losses in the ratio of 2:1. At 31st December 2021, the assets and liabilities of the partnership were as follows. Okay, then the partnership closed on 31st December 2021. And now we need to figure out L's share of the profit on realization. Okay, so I'm just going to create a statement or realization account. Okay, in the realization account, we just record the assets at its net book value on the debit side and its disposed value on the credit side. And in this case, we can see that the non-current assets were sold for 654,000. So its net book value was 600,000, which should be recorded on the debit side. And its disposed value is to be recorded on the credit side. So that's 654,000. Then we're told that inventory was sold for 80,000. So this is the disposed value, should be recorded on the credit side. And the original net book value is 50,000, which should be recorded on the debit side. Then we are told that all trade receivables were collected and trade payables were settled at their book values. So book values does not need to be recorded on the realization account, because that would be the same amount on both sides, which would cancel each other out. So we can just not record it for now. Then we have our realization expenses, which was 6,000, and realization expenses are always to be recorded on the debit side. So that will be 6,000. And now we need to figure out the profit on realization. Okay, so profits on realization are always recorded on the debit side, which means that our balancing figure is going to be on the debit side. So we need to figure out the total from the credit side first. That's the sum of these two amounts, 654,000 plus 80,000, which results in 734,000, which would be the same for our debit side as well. Now our profit on realization is the balancing figure, and in order to figure it out, we just need to subtract these amounts from the total. In this case, that's 734,000 minus 600,000 minus 50,000 minus 6,000, which results in a value of 78,000. So this is the total profit on realization, but we only need to figure out L's share of the profit on realization. Let's have a look at the profit sharing ratio. That's 2:1. So out of 3 parts, 2 parts belongs to L. So we just need to figure out 2 parts out of 3 parts for this amount of 78,000. That's going to be 78,000 times 2 by 3, which results in the value of 52,000. This is L's share of profit on realization. And this amount is given in option B. That would be our correct answer. Now we can move towards question number 16. X, Y, and Z are in partnership, sharing profits and losses in the ratio 5:2:3. Y is entitled to a salary of 18,000 per annum. Partners receive interest at 6% per annum on their capital account balances at the beginning of the year. And we are given the capital account balances at the beginning of the year for all 3 partners. The profit for the year before Y's salary and partners' interest on capital is 140,000. Now we need to figure out Y's share of the total profits. So we can figure it out by creating appropriation account, right? And we always start with the profit for the year before any salary or interest on capital, and which is given to be 140,000. Now the first step would be to adjust the interest on capital. And remember that interest on capital is something that the partnership needs to provide to their partners, which would definitely reduce its profit, right? So we just need to subtract the interest on capital. Okay, and this is to be subtracted for all 3 partners, X, Y, and Z, and the interest is 6%. So for X, that would be his capital balance of 30,000 times 6%, which is 0.06, which results in the value of 1,800. This should be subtracted. For Y, that's the balance of 22,000, so that's 22,000 times 6%, which results in the value of 1,320. This should be subtracted as well. And for Z, that's 20,000. So 20,000 times 0.06, which results in the value of 1,200. And this should be subtracted as well. Alright, and we're also told that Y is entitled to a salary. And salary is provided by the partnership, which would again reduce the profit. So that's minus salary to Y, which is 18,000. Okay, after adjusting all of these amounts, we get our residual profit, right? That's the sum of these 5 amounts. 140,000 minus 1,800 minus 1,320 minus 1,200 minus 18,000, which results in 117,680. And we only need to figure out Y's share of profit. So let's figure out Y's share of the residual profit. We know that the profit sharing ratio is 5:2:3, so 2 parts out of 10 parts belongs to Y. That would be 117,680 times 2 by 10, which results in the value of 23,536. Okay, now the very common mistake would be that the students would tick this amount as the correct answer. But remember that Y is also receiving the salary of 18,000. So this is also what he receives, right? So we need to adjust that amount, 23,536 plus 18,000. And remember, he also receives the interest on capital. and the interest on capital for Y is 1320. So we need to adjust that amount as well. And now this gives Y share of the total profits to have the amount of 42,856. So this is the correct amount, and this amount is given in option C. That's the correct answer. Now we can move towards question number 17. During the year, a business issued 1 ordinary shares at 1.20 each. So this is the nominal rate, whereas we are issuing it at a higher rate, which means that we have our ordinary share as well as the share premium. And the directors proposed a final dividend at the end of the year. Which balances in the statement of changes in equity were affected by these transactions? So obviously, while issuing a share, it affects our ordinary share capital, right? And since we are issuing it at a higher rate, our share premium also gets affected. But remember that the directors are only proposing a final dividend. They have not yet been paid. So this does not affect any of the columns for our statement of changes in equity, which means that only ordinary share and share premium will be affected. And that is given in option A. That's our correct answer. Now we can move towards question number 18. The following items were taken from the bank transactions of a company for a period. We need to figure out the net increase in the company's bank balance as a result of these. Alright, so the very first one we have is share issue proceeds. So this just means or indicates the amount that we received for issuing the shares. So this would definitely increase our bank balance, right? So we will be adding the 30,000. Then we have a sale of non-current assets. While selling non-current assets, we give out our non-current assets, and in exchange we receive the cash amount, which means that our company's bank balance would definitely be increased by the sale of non-current assets. So we will be adding this amount of 5,000 as well. Then the third one is dividend paid. So we are paying it out, which means that our bank balance would be reduced by this amount. So we're going to subtract the 9,000. And then we have increase in bank loan. This just means that we have taken a bank loan that would definitely increase our bank balance, right? So we need to add the 6,000 as well. And this gives our net increase. So that's 30,000 plus 5,000 minus 9,000 plus 6,000, which results in 32,000. So this is the net increase in our company's bank balance, which is given in option B. That's our correct answer. Now we can move towards question number 19. On 1st January 2021, W Limited had total revenue reserves of 122,000. During the year ended 31st December 2021, the following took place. Okay, I'm just going to see what we need to figure out. What was the total of the revenue reserves at 31st December 2021? Okay, so we start with our opening balance for the revenue reserves, which is 122,000. Now, the very first event was a dividend paid. So dividend of 7,500 was paid. And remember that dividend is always paid out of our revenue reserves. So this amount would definitely decrease the total for revenue reserves, right? So I'm just going to subtract the 7,500. Then an amount of 10,000 was transferred from retained earnings to general reserve. So remember that both retained earnings as well as general reserve is a part of revenue reserves. So this would just mean that we would be taking out 10,000 from one of our revenue reserves and adding that 10,000 to another revenue reserve, right? So this does not really need to be adjusted. Then the third one is that the premises were revalued upwards by 19,800, and this revaluation upwards is to be recorded in our revaluation reserve, which is not a part of revenue reserve. So this event does not affect our balance for the revenue reserves at all. Then we are told that for the year ended 31st December 2021, W Limited made a profit for the year of 32,000, and profit for the year is recorded in our retained earnings, which is a part of revenue reserves. So this 32,000 should also be added here. Alright, and this gives the total of revenue reserves at the closing date. That's 122,000 minus 7,500 minus 10,000 plus 10,000 plus 32,000, which results in 146,500. And this amount is given in option C. That's our correct answer. Now we can move towards question number 20. What would increase the current ratio of a business? And current ratio is just the current assets divided by current liabilities. So for this entire ratio to increase, either the numerator factor should increase, which is current assets, right? Or the denominator factor should decrease, which is the current liabilities. Now, let's have a look at our options. Buying goods on credit. So while we buy goods on credit, this would only increase our inventory, right? So our current assets is increased. and selling immediately for 3,000 cash. So previously it was increased for 2,000, but after we sell immediately for 3,000 cash, our cash increases by 3,000, right? So increase 3,000, whereas our inventory will decrease for 2,000. But overall, there is obviously an increment of 1,000 in our current assets section, right? And this is the condition that we require. We require our current assets to increase, which means that option A will be our correct answer. But let's have a look at the remaining options as well. The second one is paying wages of 1,000 in cash. So this would reduce cash, which means that our current assets would also be reduced. That is not the condition we require. So option B is incorrect. The third one is purchasing a non-current asset of 10,000 on credit. So while we purchase non-current assets on credit, our cash does not get affected at all. So it remains constant, but we require it to increase, right? So it's not the condition that we require. And the fourth one is selling goods of 1,000 at cost price on credit. So if we sell goods on credit, this just means that our inventory will decrease, but our cash will not increase. So overall, our current assets will be decreasing, and that is not the case that we want. So option D is incorrect as well, which means that the correct answer is still going to be option A. We can now move towards question number 21. The following information is available for a business. Now we need to figure out the rate of inventory turnover. And the rate of inventory turnover is just the cost of goods sold divided by the average inventory. Okay, let's figure out the cost of goods sold. We know that its formula is opening inventory plus purchases minus closing inventory. And in this case, we have the inventory at 1st January 2021, which is the opening inventory. That's 3,500 plus purchases, which is given to be 21,000 minus closing inventory, which is at the date of 31st January 2021, and the amount is 2,800. So the cost of goods sold is 3,500 plus 21,000 minus 2,800, which results in the value of 21,700. Now we also require the average inventory, and average inventory is just the opening inventory plus closing inventory divided by 2. In this case, the opening inventory has the value of 3,500 plus the closing inventory has the value of 2,800 divided by 2, which gives the amount of 3,150. So we just need to substitute these two values. That's 21,700 divided by 3,150, which gives the value of 6.89. So our rate of inventory turnover is 6.89 times, which is given in option B. That will be our correct answer. Now we can move towards question number 22. We need to figure out which statements about a semi-variable cost are correct. And remember that semi-variable costs are those costs which contain both the fixed as well as variable cost component. So the first statement is part of the amount always changes for any level of output. So if it is changing for any level of output, we can only categorize it as the variable cost, which means that there is no fixed cost component involved. So statement 1 is incorrect. The second one is that the part of the amount changes for a given level of output. So for a given level of output, it is being changed. So that's a variable cost. But after that level of output, it is going to remain constant, right? So that adds the fixed cost component, which means that this second statement is correct regarding a semi-variable cost. And the third one is that the amount always changes for a given level of output. So if it is always changing, it only incorporates the variable cost component and not the fixed cost component, which means that this will be incorrect. So the only correct statement is 2, which is given in option D. That's our correct answer. Now we can move towards question number 23. A company has a financial year end of 30 November. It has no opening inventory at the beginning of the financial year. And during the year, the following amounts of inventory are purchased. Sales for the period are 500 units at 100 each. So these are the number of units sold. Let's figure out the total number of units bought. That is just going to be 330 plus 288, which results in 618. So out of 618 units, 500 units are sold. And inventory is valued using the average cost AVCO method. Now we need to figure out the value of inventory to the nearest dollar. Okay, out of 618 units, 500 units are already sold. So only the remaining units is going to be treated as the inventory, and that is 118 units. So we now need to figure out the average cost for 180 units. First of all, let's figure out the total cost for the total number of units, which is 618. So for 330 units, the unit cost was 50. So For 330 units bought on 30 March, the unit cost was 40. So the total cost is just going to be the product of these two amounts. So that's 330 times 40 plus for the units of 288 bought on 1st November, the unit cost is 50. So the total cost would be the product. So that's 288 times 50, which gives our total cost to have the value of 27,600. And now this is the total cost for 618 units. Let's figure out the cost per unit. And we are figuring it out under the average cost method. So we just need to divide the total cost by the total number of units. That's 27,600 divided by 618. Okay, this gives our cost per unit to be 44.66. And we require the cost for all of our inventories, which is 118 units. So the inventory value is just going to be the cost per unit, which is 44.66, times the total number of inventory, which is 118. And this gives our total inventory value to be 5,269.88. Now we need to round it off to the nearest dollar. So that's going to be 5,270. And this amount is given in option B. That is the correct answer. Now we can move towards question number 24. A business has the following budgeted data for a production of 50,000 units. All right. And to determine the selling price, the business adds 40% on the cost of production. Remember that this is a total cost and not the cost of production. So let's first of all figure out the cost of production. Cost of production only includes the factory costs, right? So the factory costs are the direct production costs, indirect labor, factory supervisor salaries, since this is associated with factory. We have our sales staff salaries. This is not to be included in our cost of production. This is actually included in our income statement section. Then we have depreciation on machinery for production. Since this is associated with production, this is to be included in our cost of production as well. Then we have depreciation on motor vehicles for delivery. Again, this is to be included in our income statement. And we have administrative expenses. This is to be included in our income statement as well. So the cost of production is the direct production cost of 300,000. Then we have indirect labor of 20,000. Then we have factory supervisor salaries of 60,000. Then we have depreciation on machinery for production of 80,000. Alright, this gives the total cost of production to be 460,000. And remember that we are adding 40% on the cost of production in order to figure out the selling price. So let's add it. That's 460,000 times 1 plus we are adding 40%. So that's 0.40. And this gives our selling price for 50,000 units to be 644,000. Alright, now we actually require the total selling price of 500 units. For 50,000 units, the selling price is 644,000. For 1 unit, the selling price would be 644,000 divided by 50,000. Now we require it for 500 units. So for 500 units, that's going to be 644,000 divided by 50,000 times 500, which results in the value of 6,440. Okay, and this amount is given in option C. That would be our correct answer. Now we can move towards question number 25. A trader rents a vehicle for 10,000, which allows him to cover 20,000 miles per financial year. If this mileage is exceeded, an additional charge of 5,000 is made. Okay, so for 20,000 miles per financial year, the vehicle rent remains constant at 10,000, right? But if the mileage is exceeded, the additional charge of 5,000 is made, which means that the total charge now would be 15,000, right? This is the graph for this kind of cost. And now we need to figure out which type of cost is this an example of. So clearly from the figure itself, we can see that there is a step being made, which means that this is a stepped cost, which is given in option C. That's our correct answer. Now we can move towards question number 26. When might a business calculate its contribution to sales ratio rather than contribution per unit? Okay, so the first one is when the break-even point needs to be expressed in units. We know that the formula for break-even points in units is our fixed cost divided by contribution per unit. So we definitely require contribution per unit rather than the contribution to sales ratio. So option A is incorrect. The second one is when the business produces and sells several different products. So if we are talking about various products, then the selling price as well as the contribution may differ for each of those products, right? And in this case, it would be impossible to figure out the total contribution. So in this case, it would not be relevant if we produce contribution per unit. So in this case, it would be easier if the business calculates its contribution to sales ratio for all of the different products. So option B is our correct one. Let's have a look at the remaining options as well. For option C, when the value of fixed cost is uncertain. That is incorrect as well, because fixed cost should be certain. As the name suggests, it is fixed, right? So this is incorrect. Then the fourth one is when there are limiting factors affecting production. So whenever there are limiting factors affecting production, we figure out the contribution per limiting factor, not the contribution to sales ratio. So obviously option D is incorrect as well, which means that our correct answer is still going to be option B. Now we can move towards question number 27. We are given the following information. We need to figure out the break-even point in units. So break-even point in units is just the fixed costs divided by the contribution per unit. Okay, let's figure out the fixed cost first. We have our selling price, variable. Okay, let's figure out contribution per unit. That is just the difference between selling price and variable cost. In this case, the selling price is 50 and the variable costs are 26 and 4. So that's minus 26 minus 4, which results in the contribution per unit to be 20. Okay, I'm just going to write it down. Then we have our total manufacturing overhead and total administrative overhead. And these two will be our fixed costs. So the total is just going to be 360,000 plus 120,000, which results in 480,000. This is the total fixed cost. Now the break-even point in units is just going to be 480,000 divided by 20, which results in 24,000 units. And this is given in option D. That's the correct answer. Now we can move towards question number 28. K Limited manufactures and sells a single type of product. The following budgeted information is available in respect of it. And the question is, how many extra units would the company need to produce and sell to increase the budgeted profit by 26,000? So this is the budgeted information. So we can figure out budgeted profit from this box itself. Let's figure it out. We have our selling price and variable cost given. So the contribution per unit is just going to be 80 minus 28, which results in the value of 52. All right. And we know that the profit is just the contribution times the number of units minus the fixed cost, right? And in this case, we figured out our contribution per unit to be 52 times our number of units is given here. Production and sales is 3,500. Minus the fixed cost. We know that the total fixed cost is given to be 70,000. So our budgeted profit is just going to be 52 times 3,500 minus 70,000, which results in 112,000. Okay, now we need to figure out the extra units. So the total units now would be 3,500 plus the extra units, right? And we are trying to figure out those extra units in order to increase the budgeted profit by 26,000. So we need to increase this by 26,000. So we're just going to add the 26,000. So this gives the new profit required to be 138,000. Okay, so we require 138,000 profit. And again, the formula is going to be contribution times number of units minus fixed cost. The contribution does not change, so that's 52. Times our number of units now is 3,500 plus the extra units minus the fixed cost. And fixed cost does not change with the change in numbers for production and sales, right? So it's going to remain constant at 70,000. All right. So now 3,500 plus E is going to be 138,000 plus 70,000 divided by 52. So now the extra units is just going to be 138,000 plus 70,000 divided by 52 minus 3,500, which results in the value of 500. So this is the answer that we are looking for, which is given in option C. That's our correct answer. Now we can move towards question number 29. M Limited manufactures and sells 2 different colors of paint. The following actual information is available for last year. Now, the company is considering closing the blue paint department. and using the extra space to increase revenue in red paint by 20%. The variable cost will increase in the same proportion as the increase in revenue. Okay, so we are closing this blue paint department, but remember that fixed cost will still remain because fixed cost does not change with the change in level of production even when the level of production goes to zero. So this fixed cost still remains, but we can just ignore these information now, right? Okay, now I will be preparing another statement. Revenue. We are told that we are increasing the revenue in red paint by 20%. So we're increasing this amount by 20%. That's going to be 350,000 times 1. Since we are increasing it, that's plus 0.20. And this gives the new revenue to be 420,000. Let's write it down. Then we have our direct materials and labor, which are variable costs. And we're told that the variable cost will also increase in the same proportion, which is 20%. So we're going to increase this amount of 180,000 as well. That's 180,000 times 1 plus 20%, which results in the value of 216,000. Okay, let's write it down. Then we have our fixed overheads. And remember that fixed cost does not change with the level of production. So the total fixed cost is still going to remain at 198,000 even after closing the blue paint department, because the fixed cost from those departments still exists, right? So that's going to be 198,000. Now we can easily figure out our profit or loss. So we will be subtracting the variable cost as well as the fixed cost. So the total profit is just going to be 420,000 minus 216,000 minus 198,000, which results in the value of 6,000. Okay, we can see that previously the total profit was 57,000 and now the total profit is 6,000. So the profit is definitely decreased, right? Now let's figure out the decrease amount. That is just the difference between the two profits. That's previous 57,000 minus current 6,000, which results in the value of 51,000. So we can say that the profit will decrease by 51,000. This is the answer that we're looking for, and it's given in option C. That's the correct answer. Now we can move towards question number 30. We need to figure out why might a business prepare budgets. So the first one is to encourage planning and decision making, which is absolutely true because budget essentially means that we plan and make decisions on which product to produce and what rates to give for each of our costs as well as the selling prices, right? So that's correct. The second one is to improve coordination between departments. This is absolutely true as well because whenever we prepare budgets, there needs to be some sort of coordination between departments, because if the production department is producing 1,000 units and if the packaging department is only ready for 500 units, then that means that there is some sort of communication gap which should not be existing. So statement 2 is correct as well. And the third one is to monitor and control costs. This is true as well because when we prepare budgets, we set a fixed amount of cost that we anticipate, but that amount can be exceeded. So we need to closely monitor and control those costs. So statement 3 is correct as well. So all three statements are correct, which is given in option A. That will be the correct answer. Okay, this brings us to the end of this paper. If you found this video useful, make sure you like this video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.